Welcome to the Agronomy and Farm Management Podcast. I'm Bruce.
And I'm Josh, and we're your farm management hosts. Let's get started.
Josh, we're approaching our holiday seasons. We're in the depth of holiday seasons, and boy, we get to the end of December and throughout the first of the year, holiday traditions. What are you looking forward to the most coming up in the next few weeks?
Yeah, Bruce. Say, I've kind of already hit on my favorite holiday tradition. Typically, I'm from Gallipolis, Ohio, and Gallipolis, they have the Gallipolisan lights. It's where they take the whole park, light it all up. They've got lights everywhere. They've got just everything you can imagine. They've got a tree that's upside down, that's all designed out. We always go down to the lights, walk around, see everything, and then we drive over to the shake shop. And the shake shop is just a local little shake shop where you can get whatever you want, just an old little diner, but they have these holiday shakes and it's cinnamon and then they've got a black cherry, but the cinnamon, oh my gosh, Bruce. We always go down there after Thanksgiving. It's like just kind of waddle in the park and we go over and get some more sugar, more dessert into us. What about you, Bruce? What are those holiday traditions that you value?
I love putting up the Christmas tree. We're not a live Christmas tree, fresh cut tree family. We've always had a quality artificial. Love the fir style of the tree. Love our family ornaments. It seems like each ornament, like many families, probably have a story for each one of those ornaments. And not that I can remember, but my wife is really good about remembering each of the stories that go along with, in fact, each of those ornaments. I remember years ago setting up a real Christmas tree with my brother, and he kind of had the Clark Griswold experience of kind of unveiling the tree. And it was big, but it was also tall in the room. And in fact, overnight, it kind of fell to the ground in the living room with ornaments on. So the next day we had a kind of a tree recovery breakfast event while we stayed the weekend there. So good times had by all.
Oh man. Say, I am not a real tree person. Never had a real tree in our house.
It's worth the experience probably once and then deciding whether or not it's a good idea again. Well, let's dive into our topic today. We're going to be talking about some tax management for the end of year, and we have a great guest with us today. Barry Ward is our guest today. Barry works for Ohio State University in the Department of Extension and is our leader in production business management. Barry's work focuses on land economics, farmland values and cash rental rates, farmland lease issues, crop economics and budgets, machinery economics, and tax issues, of course. And we have the right person for the job today because Barry is also the director of our OSU income tax schools, and he helps teach and organize those schools for our tax professionals by providing that tax education to our Ohio agricultural sector. So, Barry, welcome to the podcast. Great to have you along today.
Thanks, Bruce. Thanks, Josh. It's a pleasure to be with you.
We're going to kick things off, kind of a reflection maybe for the farm economic situation that we're in. And the question we're going to start with is, what should a farm manager consider for tax planning in a low income year? Maybe that low income year was partially driven because drought conditions here in Ohio.
Yeah, that seems to be one of the key questions that we've been dealing with as far as tax planning and farmers as they evaluate what they're going to do as they move forward into 25 and evaluate how their tax return might look for 24. This is a key question. And well, we hope that they're going to be consulting with their tax practitioner or their professional if they are working with them. But we're in a kind of a transition period, as you both know, and as many of our listeners will know, of course, this is not news that we've gone from a period of higher income, higher net income or higher taxable income in 21 and 22 to a kind of a transition year in 23 to 24 is going to be a pretty rough year for many. They're going to probably see much lower net farm income, and 25 is likely to look much the same. So we know most farmers are cash basis taxpayers. So in other words, they're able to have some flexibility, and many of them may already know that. Many of the listeners out there, you're well aware, but it enables you also to use a calendar year, which most are on. So grain farmers in particular can manage that net farm income a little bit at the end of the year. And the ways that they do it, and this will be no different, is to perhaps hold on to some of that grain or push it into the next year and either market it at the end of December or the first part of January if they need cash flow. But just by selling it in a different calendar year, it's going to really impact their net farm income for tax purposes. And the same with buying stuff. It's a very technical term, right? But when we're talking about farm machinery, it may be grain bins, it may be installation of field tile, but putting the money to work towards things that they might already be contemplating having to make those purchases for, but doing it maybe in this tax year versus the next tax year to help manage some of that net farm income and try to make that net farm income a little bit more even from year to year. Not have that big giant net farm income in one year and maybe a zero or a negative in the next. And that's what being a cash basis taxpayer allows farmers to do. What we're transitioning into in your original question is how to manage low income or a drought year. So a lot of Ohio is going to be in this boat. We've experienced a lot of drought this year. So many producers, many grain farmers had lower yields, and all of us have experienced lower crop prices. So farmers, however, in most cases, most situations, and they pushed some of that gross income or those grain sales, they kept pushing that forward to the next year in storage and then not selling it to the following year. So there may be still some that are trying to put some of that gross income that eventually translates into net farm income for tax purposes. Well, they put that into 23 and 24, or they tried to, do that. So I guess the final answer is, how is a farm manager considering tax planning? Well, there's a number of other things that they can do. We've been, of course, trying to even out that net farm income. 24 will be a year where we can leave some of that grain income in this year. Maybe we pushed from 23 and even some from 22. And when I say push, they just allowed some of that grain and storage to be held over. But there's a number of other things. And we're looking at probably receiving some crop insurance indemnity payments. And growers, if that crop insurance indemnity payment was a result of crop loss, and almost all producers have revenue crop insurance. But if the portion, the indemnity payment portion is coming to them is due to the crop loss or the destruction or whatever it might be, in most cases it's drought this year, that portion they can defer until the following year. Now there's a little bit of complicated math that they might have to do to figure out how much, but they might also lean on their crop insurer to help them figure out what the portion was due to price loss and what the portion due to crop loss was. So that can be deferred. There's other things. And for those that have livestock, there's a couple of Internal Revenue Code sections that allow for us, in the event of natural disaster, in this case drought, for most of the counties in Ohio that did see that declaration, we can defer some of that livestock sale income that we might have had to make due to the drought. If we had to sell some beef cows due to not having enough pasture or hay, or if we had to sell some of those background feeders that we might have had out on pasture that we just didn't have enough forage for, there are some opportunities and some flexibility there for producers. And the last one that I'll just mention in this section is the net operating losses. So we can take a loss in a given year. A farmer can have a loss on their Schedule F and have the ability to take that loss and apply it to another year where we may have positive income and offset that. So let's say in 24 we had a net operating loss. We can take that negative year in 24, and farmers have the opportunity to move that loss year and apply it to 2 prior years or years into the future indefinitely. So that's the opportunity that we have. In many cases, farmers, they have some flexibility, and they need to be thinking, and many of them have, I'm sure, as we had a kind of an early harvest this year for most, they've had a little bit more time to think about these things. But a long answer to a short question. Sorry, Bruce.
Barry, in recent years, there have been some renewed interest in residual fertility, fertilizer deduction. Can you explain the situation and give some guidance to tax filers?
Yes, Josh, that's a real hot issue in the last couple of years. It's been in the farm press a lot, but mainly what we're looking at in terms of this issue is that people, taxpayers that are acquiring farmland, whether through purchase or even through inheritance, you have the opportunity to take that purchase of that asset, that farmland, and apply different values or tax bases to the different components of that purchase. That's kind of the real basics. So the one thing that people that are buying farmland will think of first is as a way to kind of bridge this understanding is that we're going to buy a farm that has already installed field tile. Drainage tile, if you buy a farm, you're probably, in most cases, you're going to be advised by your tax practitioner and others to assign a value to the land itself and a certain portion of that purchase price, assign a value to that tile. The reason that you can do that and the reason that you would want to do it is then you can depreciate that again, if even if that previous owner has fully depreciated that asset. And the same with barns or grain bins and other things that might go along with that purchase. The one thing then that has gotten a lot of press is this idea of taking excess fertility in the land and making that into an asset in and of itself, and then being able to depreciate that. Code section 180, if anybody really wants to dig into that, it just allows us to take those soil amendments, those things that we normally do in a given year, fertilizer that we purchase and apply to the land, we write it off, right? We expense that. We put it on our Schedule F as an expense to offset some of that gross income. In this situation, you buy land or you're inheriting land, and if you've got excess fertility, now the way I define it, and others will define it a little bit differently, and I'm not an agronomist, and you guys will understand this better than I do, but anything above those critical levels, I think, is fair game. Think about P and K. Those levels will remain in the soil, and if you have buildup above those critical levels, I think that is the amount that we could consider for allocating a certain tax basis to upon acquisition of that farmland, and then having the ability to expense that, just like we would buying a farm with field tile. It's getting a lot of press. It might be considered a bit of an aggressive tax position, but the IRS at this point has not challenged those taxpayers that have done this the right way. And the right way to do this is when you buy the farm, make sure that you have a certified agronomist or a certified crop advisor to do a thorough analysis of the farm's soil. So we're going to take soil tests, we're going to send them to the lab, we're going to get a complete report, and also have that certified agronomist or other professional in that field write a report indicating basically the timeline that it's going to take for that to be used up, that excess fertility. Oftentimes, when people are taking this and utilizing this excess fertility deduction, they're not going to write it all off in the year of purchase or inheritance, but they're going to be doing this over a 3 to 5 year period, depending on what that expert is going to indicate on the report. But that's the key consideration that the IRS is indicating, that if you're going to survive an audit on this particular issue, if you were to ever get audited, you better have that report. If you've been seeing this or if you've been asked questions about it, those are the basics, and I'll answer any more questions if you guys have them on that issue.
Barry, speaking of the basics, for our audience, let's go back to some of the basics of income taxes for farms. Let's review what are the types of income taxes that farms potentially pay based on our accounting systems and what we provide as information to the IRS.
Yeah, that's a real good one. It's always useful to take a step back and kind of review the basics. Okay, farm income. Whether you're a livestock producer, a grain producer, we're going to assume that you're going to be filing a Schedule F. And if you're a farmer, you should be filing a Schedule F. Okay, so that's what you or your tax practitioner, that's where they're going to put all of your farm income and expenses on that, excluding a couple of things that we'll mention in a moment. Your net farm income, that it's at the bottom of the Schedule F after you take your gross income and subtract your expenses, your allowable expenses for the farm for that year. You're going to have taxable income that's subject to all the same tax brackets that everyone else is. We call that ordinary income tax. It's the same as those that are salary or a paycheck and getting paid periodically. That farm income is subject to that ordinary income, and that it is ordinary income and subject to ordinary income tax brackets. Additionally, that farm income is subject to what is called self-employment tax. All right, self-employment tax is substantial. It's 15.3%. It's not a bracketed type of income, so it's all subject to the same amount until you reach a certain level, and then it's only subject to a smaller amount. Okay, self-employment tax made up of two components, Social Security and Medicare. And for wage earners, those that are receiving a paycheck, if you don't have another retirement system, then a wage earner, those earning a paycheck, are going to be only paying half of that. Their employer pays the other half. So it's different for those that are self-employed, however. They pay the full freight on that. So the full 15.3%. There's a Social Security ceiling, if you will. Your income is subject to the 15.3% up to a certain level, and that's the cap. And anything above that's only subject to the Medicare portion of that, which is a smaller percentage. Okay, so enough about that. More than you wanted, perhaps, but there's also state income tax, Ohio state income tax, and that is a smaller percentage. Also in brackets, that ordinary income that's taxed for state purposes. However, the state of Ohio has a $250,000 business income deduction. So anybody that has a business that qualifies, and farms do, the first $250,000 of net farm income is excluded and is not taxed for Ohio purposes. One more, farm machinery sales. It's a quirky one, but farm machinery sales are subject to ordinary income tax rates, but not subject to self-employment tax. So that's something that gets into recapturing. It's called income recapturing that. So it's a complex subject we won't get into here. For farm sales, for land and that type of thing, those are capital gains as long as that land is held for a certain amount of time. Much lower percentage, much lower tax at 20% is the cap on that. And oftentimes people are concerned and they worry about capital gains, but actually that capital gains taxes are much lower than our other taxes. So shouldn't be a concern. Actually, we want to try to have our income qualified as capital gains. One area that we do, and that is the sale of breeding livestock. Okay, as long as we hold those for a certain amount of time, breeding livestock is going to qualify for capital gains income that's purchased breeding livestock. Okay, more than you wanted on that perhaps too, but that's as quickly as I could do it.
Barry, let's talk a little bit about some strategies we can do when talking about income tax management. What are some short-term and long-term strategies that farmers should consider over their farming career?
Before we get into, I guess, some of the philosophical types of things that we might talk about, and Bruce, I'll bring Bruce into that conversation in this part too. First of all, record keeping. Farmers having a good system, hopefully something beyond just a shoebox or a file drawer full of income and receipts, although some still get by with that. We would encourage that would be able to do more than just keep records for tax purposes. We want to go beyond that. But as far as this goes, I don't know, Bruce, do you have anything else to mention in kind of that record keeping area?
Yeah, I think one of the stressors of tax season is organizing the information that has happened over the past 12 months at least, and to have an accounting system that can pull reports that have had input throughout the months, as income and expenses are recorded each month of the year. And then at the end of the month, we can verify the accuracy by running some reports and maybe ground truthing them. But the heavy lift of organizing the information can and maybe should be done by the accounting system throughout the year to make tax season just a little less stressful, and then allowing the tax forms to be filled out because we have the totals and the amounts already organized.
totally agree because on a normal year, harvest for many of our farmers doesn't wrap up till close to Thanksgiving. Then we get into the holiday season, and then about the 1st of December, then the focus finally falls on how are we going to manage the taxation this year. And then we go to our records and we find them in disarray, and we have to go back 6 months and try to recreate. So yes, this idea of doing that throughout the year, having a system that helps quickly summarize, that can be a huge benefit. Then meeting with your tax practitioner to kind of go over some of the things that might be helpful in terms of tax planning. The one thing that is a trap, and we know this from years and years of experience, is farmers making decisions at all costs to limit their tax bill in a given year. At some point, it might do us more harm than good. So we look at this, we're kind of in the middle of the case study right now. And for many farmers, it's going to be okay. But for some, it's going to add some stress because in the years 20, 21, 22, we had relatively higher net farm income, especially with grain producers. Now, setting aside that, you would look at livestock producers where they had to buy higher priced feed, they may have had lower net farm incomes in those years. And this upcoming period is going to be a little bit more relief for them because they're going to have lower feed bills. But let's take the case of the grain producer that is, they experienced those high net farm income years, and they decided that, well, they needed to buy some things and upgrade. And in many cases, I'm sure that that was needed. But in some cases, there may have been some purchases made that may not have been necessary just in the name of eliminating any taxable income. Now that we're falling into a period of lower net farm income for grain producers, in many cases, there may not be enough working capital due to the fact that we, instead of carrying some of that cash and paying some tax in those years, we may be in a period where we're a little bit more cash strapped and may have to take some more loans out that may be a higher interest rate, obviously. So I guess that's one of the main messages, that just trying to think a little bit more about whether or not we really need to zero out net farm income in some of those real high income, net income years and looking for the future. But, right now we're faced with the other side of it. And I guess that's more of a message for the future, is just making sure that we have a clear understanding. And Bruce, you can weigh in more on that if you so choose.
That's great advice. That's great advice. There are some short-term strategies, but we can't forget the long-term impacts of those things. Barry, you had a couple of brief mentions that we wanted to take a look at in this episode, two to be specific, and I wonder if you might do a couple of those. The first one is related to farm loan immediate relief under Inflation Reduction Act. Okay, that's a mouthful in and of itself. And then we'll mention another one as we go through. So two of those kind of brief mentions that might apply to some, but probably few here in Ohio.
Yeah, as part of the Inflation Reduction Act, there was extended the opportunity for farms to find some loan relief if they had some difficulties in paying some of their loans. So growers, some farmers had the ability to do that. And if they were granted some relief on some of those past due loans with the FSA, that's going to be considered taxable income, firstly, for most of them. So they would have received, as we all do normally, when we receive a government payment or some kind of a issue of payment like this, where we're just offsetting loan amounts, you're going to receive a 1099G from the government. Okay, so in most cases, that's going to go on the Schedule F, and that's going to be taxable income. However, in this particular instance, there was reclassifying of some of that income. Some growers were reissued a 1099G for that loan relief, or they were issued a 1099C in replacement of that 1099G. Now, there's very few growers in Ohio that qualified for this farm loan relief through the Farm Service Agency, but there are a handful. So my best advice is that make sure if you get one of these 1099Gs or 1099C, and it may have been even for the 23 tax year, make sure that that was handled correctly go back and do some reading, join us, or you can ask us further questions on this particular issue. But you may find that you may have to file an amended return if you didn't handle that particular income correctly. So I guess that's the main point. It's a fairly complex issue to get into, and since it's just such a few people that will be affected, I'm not going to go into all the details here.
The next brief mention was the taxability of USDA discrimination financial assistance awards.
Right. Yes. Also, as a part of the Inflation Reduction Act, those that were deemed to have been discriminated against in the past and did not perhaps receive the service or the loan service that they should have, there were certain payments that were distributed for those individuals if they qualified. Those particular discrimination financial assistance awards are all taxable. They should receive a 1099-G. Now, the one little bit of a quirk in this one is that some may still be farming, and that income will go on the Schedule F. Some that may not be, or maybe never farm due to the fact they didn't receive the loan. They may not be a farmer currently. So that's the real issue as far as where we're going to place that income. And it's going to go on your Schedule 1 of your 1040. And there's more details on that, but that's going to be ordinary income, but not subject to self-employment tax. So that's a little bit of an issue that those that are going to receive these financial assistance awards are just aware of as to where to place that income.
Barry, there's a deadline approaching related to the beneficial ownership information. Can you elaborate a little bit on that?
Yes, it's one of my favorite topics. Not really, but we've been talking about this since last year at our income tax schools in 23, alerting people and our tax preparers that join us for those tax schools and some of our webinars that this was coming. You know, it was this beneficial ownership information reporting was a part of the Corporate Transparency Act. You can go and look at all the details on that if you really want to. But the bottom line is that anybody that has a business entity that is filed with the Ohio Secretary of State and also the same agency, whoever handles business filings in each of the states across the country. If you have a business, for example, the most common one for many of our farmers in the state of Ohio would be an LLC, limited liability company. If a farm has an LLC or it's organized as an LLC, or they may have multiple LLCs, and oftentimes many of our farm businesses may have their land owned under a certain entity, the farming operation under another, and maybe a trucking firm located or operated as another. So what they're being asked to do by the end of this year, and right now it seems like Congress is not going to pass any legislation that will extend this deadline. And the Treasury, the U.S. Treasury, the FinCEN entity under the U.S. Treasury is not going to extend the deadline. We're going to have to do this, and people are going to have to file this information with FinCEN. FinCEN is the entity that's handling this. This is the Financial Crimes Enforcement Network. The reason this was passed a few years ago is that they were hoping to find bad actors, those that are out there they're laundering money, among other things, the terrorist organizations that might be hiding in these companies. So that's why this was passed. And that's why they're requiring that anybody that is a major shareholder or a member of one of these corporations or LLCs file this this information reporting. So have to do it by the end of the year. There's a number of things that they have to file, but it's fairly painless as I understand it. Now, I don't have an LLC myself, so I haven't had to do it, but my nephew has an LLC for his trucking company, and I've talked to a few others that have done it, and it can be fairly quick and painless. If it's a small number of members in an LLC, 2 or 3, or even up to 4 or 5, you have to have a photo ID that you have to scan and upload. But other than that, it's pretty standard information, and it could take 10 or 15 minutes.
Quick and painless. You heard it here first.
That's the sales job, those that have to do it. And it's only a one-time filing unless you have a change of address. or a change of something else with your passport or your driver's license, one of which you have to upload.
Sure.
Okay, enough on that.
Yeah. So Barry, in the last couple of years, we've heard a lot about the Tax Cuts and Jobs Act provisions. And I wonder if you might be able to speak briefly to a few of the pending expirations or what we might call sunsetting of some of those provisions.
Yes, it's one of those things and also goes to tax planning. But with all of these sunsetting and with the change of Congress, and even with Congress all being, Congress and the administration even being under the leadership of one party, we expect there to be a contentious debate this next year in Congress, both in the Senate and the House, and also at the administrative level at the president's desk, as to which of these provisions get extended, which get deleted or allowed to sunset, which get tweaked a little bit and allowed to continue. But okay, so the Tax Cuts and Jobs Act was passed in 17 and took effect in the 2018 tax year. There were reductions in the individual tax rates and the favorable tax brackets that, or the more favorable tax brackets that are in place now. They would revert back to the previous tax brackets, which are generally a little bit higher in terms of rates. So those are sunsetting. The increase in the standard deduction sunsets. Personal exemptions, those were eliminated. They'll come back if they're not extended. Their increase in child tax credit. One of the biggest issues that's going to be a problem is the state and local tax deduction limitation of $10,000. You've got even Republicans that are going to be in some of these states, especially that have higher property taxes and state taxes, state income taxes, that are going to argue for higher SALT limitation. It's going to be a battle, I think, that particular issue. One of the biggest things for farmers and any small business owners is that the qualified business income deduction of 20% is set to sunset at the end of this year unless they extend that. That 199A deduction or pass-through entity deduction. It's got a lot of names out there, but most of the farmers and small business owners are very aware of it. And if that were to go away, well, that would jump the tax bill up a bit. There's other things that are listed. The other big thing that in the farm press, and we've had discussions, Bruce, on this, is that the sunsetting of the higher estate tax exemption. And that's something that I know Robert Moore is going to talk about more in our webinar at the end of the week. So it's going to go from the 10 million adjusted for inflation per person, estate tax exemption or unified credit, as they call it, back down to pre-Tax Cuts and Jobs Act level of 5 million. And we think adjusted for inflation, but we don't know if it did revert back, if it would be adjusted for inflation. So it's going to be a substantial decrease in that estate tax exemption if it were allowed to sunset. So a lot of people concerned and lobbying for that to remain, but we'll see how that goes. There's a few other provisions as well, but those are some of the real key ones that I think farmers will be interested in.
As Barry mentioned, on December 6th, this Friday, on Farm Office Live, it's going to be a special edition with farmer and farmland owner tax webinar from 10 a.m. to noon. To find that, it's linked in the description. It's go.osu.edu/farmofficelive. Barry, do you have any final thoughts for us before we wrap it up?
Well, there's a couple of places people can get resources. Pub 225, or otherwise known as the Farmer's Tax Guides online. There's also a really good site called ruraltax.org. That's an easy one to find. That's also a university-based website that Ohio State's a member of that particular consortium. But ruraltax.org is another great resource that people can find good, basic, and very digestible, very readable information for the layperson. So you don't have to be a tax expert to go onto those websites and really, I think, get some helpful information. So, and just lastly is if you haven't already, if you have a tax professional that you work with, be encouraging you to kind of meet with them and going over plans for not just this year, but this upcoming tax year.
Thanks for listening today.
For more information about farm management tips, be sure to check out the Farm Office at farmoffice.osu.edu.